Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Ramsey, good morning.
Good morning. Happy to be here.
Mark, glad to have you here.
Good morning, Paul. It's great to be here with you.
We're missing Will Moorcroft, but we'll hopefully get him back for our next episode. Today, we've got a very special guest and a topic that I think will be a new one to a lot of people who are listening to the show, but I think one that's exceptionally relevant. Think if you're advising your clients, think about the questions you get around Social Security, around the future of healthcare, or in your own business. Best interest standards, real, will it happen? When will it happen? What extent? What if you had a crystal ball where you could actually predict with great certainty how these policies that impact either your business or the sort of underpinnings of your financial plan will impact your clients? What would that do for you? Well, today we're going to actually talk about a tool and a company that actually could do this for you. And so today I want to welcome Barbara Matthews, who is the CEO and founder of BCM Strategy. She served as a senior policymaker in the United States government, as well as a diplomat for the United States in Brussels. She's a senior strategist. She's an advocate for global banking, and she's an advisor to a number of large asset managers. Barbara, welcome to our show. And just tell us exactly, what does your company do, and explain how people actually get access to this information.
Well, thanks so much, and thank you for having me on the show. I'm looking forward to discussing all of this with you. So what we do, actually, we are no longer advisors to individual asset managers. We just don't do that because we're a technology company. And so as a technology company, we thought it would be better not to be in the consulting business. So the patented technology that we use was designed during the great financial crisis to advise large asset managers on policy trends and trajectories. But when we crossed the bridge into full-on technology startup, we had to leave the consulting behind. So this does have a track record, but it's not, right now we want to give more people the opportunity to make solid decisions. We don't think about it as predicting, we think about it as anticipating. We think about it as nowcasting for public policy. And if you're familiar with what the Federal Reserve does with data for economic policy, their nowcasting framework, we are just applying to the public policy process. How do we do that? What does the patent do? The patent takes the words of the public policy process and converts those words into numbers using objective political science components, not sentiment. So we are not measuring whether a policymaker likes an idea. We are not measuring voter sentiment. We are not measuring voting patterns. We are anticipating policy trajectories based on concrete actions governments take and comparing that with what policymakers are quoted in the media as saying and what they are leaking to the media. Our system automatically and accurately identifies leaks to the media.
So in a sense, what you do is you help determine the delta between what's policy fact and what is policy rhetoric in the marketplace.
Precisely. And part of the reason why we do this is what I learned when I was on Capitol Hill and when I was a diplomat for the Treasury Department as well as for the State Department. The vast majority of what government does is hiding in plain sight. And journalists don't have the bandwidth to cover it all. Editors make strategic decisions about what they want to cover based on what's newsworthy that day, but there's more out there. And if we can add visibility and increase the accessibility of concrete objective facts to an investor, we think the world is a better place because people have the capacity to make better decisions based on better information.
So what are some of the kind of the things that sort of slip between the cracks here? So I hear what you're saying. It's, there's a certain way that politicians talk. There's a certain way that reporters report for whatever commercial agendas or habits or skill sets they all have. But in between all that, there's some sort of underlying truth. What are some of the things that tend to slip through that only a trained eye would typically see?
Well, it can be a couple. I'll give you a high level answer, and then I'm going to give you detailed examples. So public policy has like effectively magic words. There are certain phrases that mean certain things to policy professionals that don't often make a good headline. And some of that is pure jargon, like the term macroprudential policy. And some of it, the digital currency space is a great example of this because the language has been evolving over the course of the last 2 years. Policymakers went from talking about cryptocurrencies to talking about stable coins to talking about digital currencies. And being able to identify each of those terms when they're used, plus central bank digital currencies, CBDC, we were able to track during 2019 the entire ramp up and the reaction function following the Facebook stablecoin announcement, the ramp up after that from the public policy community into central bank digital currencies, culminating in the G20 and Financial Stability Board meetings in the autumn of that year. Having followed it, so while most media outlets were chasing cryptocurrencies and stable coins and Facebook and were they really going to be able to get what they wanted out of that construct in Switzerland, instead we were able to identify what policymakers were doing to get ahead of the game and to expand the regulatory perimeter. So those firms are now, I think, a year later, very aware that the regulatory perimeter is expanding significantly into their space, and digital currencies issued by sovereign central banks are absolutely making a run for significant competition in that space. We track it at the level of the individual term, and that brings into high relief what the policy trend is, because most of this activity is not covered, even by the CoinDesk and the like. I mean, they don't cover it at this level. And so anyone who's armed with this information can see the policy trend emerging and prepare for it, whether that means preparing your internal compliance function or preparing your investment strategy.
So
we're also able.
Go ahead.
I'm sorry, Ramsey.
I was just going to say, so just thinking about it, so if you're not looking at it this way, then you're sort of making the binary decision: is this going to happen or not? Not quite sure, but with sort of your analysis of the language, you were determining that there was an underlying comfort, like there was that policymakers had bought in a way that, sort of skewed the probability of something more friendly to cryptocurrency happening down the road. Is that the best way to interpret it?
Well, the way we saw it was they were mostly running scared and realizing there was a competitor out there that they hadn't had before and they needed to start acting quickly. And by the way, that competitor wasn't just from the markets, it was also from China. So there's a lot in the mix that you see. Absolutely, you can get ahead of it. You can see it developing. You can do nowcasting with it, and that is the key thing. There is that you're doing it based on concrete facts. You're doing it on what the policymakers are saying and doing. It's not about hope. The old saying is hope is not a strategy. In our industry, that translates into headline risk. So from our perspective, instead of reacting in a knee-jerk emotional way to a headline or offloading the decision to a bot that reacts to a headline, we enable human beings to outperform a bot and say, well, hold on, I know that headline cannot be true. Or I'm not going to make my investment decision based on my personal emotional reaction or somebody else's opinion about what may or may not happen. I could have the opinion that tomorrow the U.S. Capitol building is going to be draped in purple cloth. I'm sorry, but what are the odds of that happening? If my system said people were buying the cloth and stringing it up, then the scenario doesn't look so crazy anymore. It's the same with cryptocurrency. It's the same with 5G policy. It's the same with the CARES Act and any regulatory policy issue that is even remotely technical, is fiscal policy, monetary policy. Because the language is technical, we have a way of decoding it and making it transparent.
Barbara, so going back to the CARES Act, I know you mentioned that you were able to predict that coming down the road, and that's obviously something that can have a major impact on our industry. How far in advance did you see that coming, and what were some of the indicators that led you to come to that conclusion?
So with a complex piece of legislation like that, and we encourage people to think about it this way, it's not the one outcome. It does it pass or not. And if you think back to the craziness of March and April, it was clear that Congress had to do something. The question at that point wasn't, will the CARES Act pass? The question was, what's going to be in the CARES Act? And there were a lot of different moving pieces to that. And what our system was able to do bit by bit, which is why we call it nowcasting, every time consensus developed on a particular point, we knew that was no longer under negotiation. And I'd have to go back through the files to find the individual bits of it. But the point is that there was more bipartisan consensus on a number of issues that were very important. And that the path toward passage is all about getting to bipartisan consensus. And we were able to pick off the individual bits and pieces as they came online. The same is true, by the way, for the most recent COVID relief package. And that is more recent, and so it's fresher in my mind what the specific details were. But when about 10 days ago, when the bipartisan group of legislators proposed two bills, not one, it was two bills, and the second bill put off to one side the two most controversial components on which there was no consensus. And those were the liability protections for corporations, which the Republicans very much wanted. And it was the very significant package of funding for state and local governments, which the Democrats wanted. And they put that in kind of a self-contained package. And the clear message here was they were preparing to jettison both. The other thing that we kept a very close eye on was about a month ago, the Treasury Department recommended that unused CARES Act funding be repurposed for the new package. And there was a lot of rhetoric and a lot of complaining, a lot of political posturing about this. But we knew that was a proposal, so we followed it. And at no point did we see anybody rejecting that idea. I mean, full on rejecting it in legislative language. And lo and behold, so what we said was, look, they're going to get to a big headline number. And indeed they did, 900 billion, roughly, give or take a couple. But when you net out the legislative language that repurposes unused CARES Act funding, which, by the way, is $500 billion. Suddenly, this new package, not quite as big in terms of new money. It's still important, don't get me wrong, and they've reallocated in ways that are going to be more effective for the American economy and the American people. I'm not criticizing. I'm just saying that if you are a fixed income analyst and you're invested in U.S. government bonds, and you see another big package of $900 billion, you're thinking, oh my God, where is all that money going to come from? Your perspective as to the fiscal situation in the United States changes materially if you know that the new package in December of 2020 isn't really 900 billion of new money. It's really only like from a fiscal policy perspective.
Okay, this is fascinating. So obviously, this has been a landmark year for federal bills that impact an industry that's largely regulated by the states. Secure Act. We thought, at the beginning of this year, we thought this was going to be the biggest thing yet, right? Oh no, but wait, there's more. CARES Act. A number of our advisors work with small businesses. We've had all sorts of PPP Act, the small business loans. Are they forgivable? Are they not forgivable? Barbara, at this point, does your tool go down to the state level? So now, if I'm an agent, I'm probably licensed in these series of states. For carriers, it's more important to kind of understand what the patchwork of rules will be. Are you looking at what's happening with state insurance agencies, or is that out of scope for your product at this point?
Well, yes and no. Right now, we do not take in data from the states, but remember, we're a startup. And if we have a customer walk in the door who says they want to take in, the data from the states, it would not take us a long time to just add those information streams. We follow a lean startup methodology, which means that we're not going to build it on spec, but we want to respond to market demand. The process is the same no matter where we train it. And it's just a question of building in the flows. So we could easily do the states.
So,
remember, it's public information. It's public information.
So
it's your right to know. You have a right to know this.
Sure. I'm thinking back to your image of the two initiatives that got wrapped together and put separately. I have this image of a magnet on the refrigerator, like something that's to be looked at but won't really be
yeah, or to use an old economy, if you think about a train, they put a caboose on that, and all they had to do was decouple it when the time was right.
Right.
And so the language here is important. So yeah, policymakers were complaining, but how they complained shifted. They didn't say no way. They never said they were not going to talk about it anymore. So following this is a hard thing to do if you're going to, it's a miserable job actually for someone to read all the stories and kind of open all these email newsletters and read all these newspapers and go to the wires. I mean, you still have to read a little if you're the advisor, but this system makes it much more, you read a lot smarter and you read a lot faster because it puts it all together for you and makes it very clear where you can go source the information.
So what's the big move for 2021? Like, we talked about some really big stuff for 2020. Like it could be around COVID. It could be around what happens with this package. What are some of the things you're seeing coming down the pike in 2021?
I'll give you my top three. And obviously COVID is number one.
Sure.
But when we look at COVID at BCM, we look at fiscal monetary policy. And we don't just look at the domestic, because at this level and because the United States is a global reserve currency, the global reserve currency by a mile, much bigger than anybody else. This is a reaction function as well. And so we look at the detailed monetary policy support mechanisms that are in place, the dollar swap lines, the various bond purchase programs. The biggest risk we see in 2021 is that all of the economies globally are going to proceed through the second half of this pandemic differently. Some economies are obviously stronger than others, the United States being one of them. Mm-hmm. And the pressure will be great for us to lay off some of the support programs so the economy can stand on its own. Other economies are not in such great shape. And I think that's going to create volatility, both in the markets and in the policy sector, because If you are in a jurisdiction, say you're in the European Union and your banks have vast amounts of non-performing loans and you don't have a good resolution mechanism, which they don't, that's going to create issues in the sovereign bond market in Europe again, or in the bond market for the banks or their equities. Whereas in the United States, we're going to be trying to get out of this. The discontinuity in the policies is going to create pressure, economic pressure, political pressure. So how the second half of this pandemic is going to be ugly beyond the obvious pain and suffering and mortality rates. Economically, I think it's a much more challenging environment because 2020, everybody was in the same boat. At the same time, everyone was putting into place all these emergency programs and nobody was going to complain that a subsidy created an unfair trade advantage.
So, all right. So here's
2021 could put us in that space.
So here's the headline I read from what you just said. So different situations for different countries. In Europe, lots of non-performing loans, likely to create some volatility there. Is it a replay of 2011? Don't know, but it sounds like you're sort of leaning that way. The way they handle non-performing loans, I guess it's bail-ins there. Is that what you were referring to? Like
Absolutely. And in fact, we've been seeing over the course of the last 3 weeks, European policymakers pivoting hard and fast toward justifying making it possible for European level entities to bail out individual banks. That's a pretty radical thing. The European, and many people don't know this because it didn't get a lot of press, but for example, the European Stability Mechanism that was created to bail out the sovereign bonds from individual countries has just been authorized. They are now authorized to bail out individual banks. I mean, politically and economically, that's like an earthquake in Europe. And this was not on the front page of the FT, but it did happen. Concrete fact. So the way the dynamic I would see is headlines about non-performing loans, banks shaky, maybe an individual bank shaky. But if you know that the ESM is authorized to do this, and oh, by the way, the ESM is not a European Union entity, so it doesn't have to get approval from the European Parliament to do anything. So if you know that there's this thing out here that can provide stability, your perspective on whether the bonds or the equity of the European bank are a good investment changes dramatically. And when you start seeing all those headlines about bank X is in trouble, you're like, well, yeah, but I know where they're going to get bailed out. And it's not going to be pick your government that is in trouble. It's going to be over here. You know that already. We know that now. So
it feels like a positive, though. It feels like a positive.
Well, yeah. Well, so I know markets love signals. Yeah. And so I hate to say positive because people then say, oh, well, you think it's a good thing normatively. Well, whether it's a good thing normatively is irrelevant. The reality is that if what you care about is stability or you want to play the volatility, it is a good thing that you know this fact exists. Yeah. It is a good thing to be armed with the facts. That is normatively good. But whether this is a good policy, I prefer not to say because we care a lot about having objective data. And I am not in the business of saying this is a good policy and that's a bad policy.
Sure. It's just if it were bail-in strategies lead to haircuts for a lot of stakeholders. That's why. So a bailout is friendlier for stakeholders than bail-in. Anyway, I'm sorry, I've been talking too much. I think, Mark, you had a...
No, I was just going to say, I mean, you think about it from, the average investor or somebody retiring today, and the challenges that they're faced with in terms of making the decision. I mean, the facts alone, if you were able to boil down to just the facts, and make a decision, that's complex enough. But Barbara, what you're doing is you're starting off with a much greater data set. You're deciphering between facts and rhetoric and noise. And obviously with the media, as politically positioned as it is today, it's even more difficult to really understand what is fact and what isn't, in a lot of cases. And so how is someone supposed to really make that best decision without being able to decipher, kind of what Paul opened up with is that crystal ball.
Yeah. Yeah.
And I think if you think about it, almost like how that ties into our industry, some of the products that are offered through insurance companies is it's really all about mitigating risk. It's trying to, identify what the scope of risk is and what the facts are, and then putting products together that can really mitigate that and put certainty there. So really what you're doing is you're creating certainty in a very uncertain environment.
We like to say that what we're doing is we're bringing the data revolution to policy intelligence. Mm-hmm. We're empowering investment managers and chief risk officers to conquer headline risk. And when you think about individual investors, whether that's from their 401k or their individual investment profile, everyone who has some kind of position in the markets today, they are very invested in big tech, whether that's through a mutual fund or the amount of retirement savings wrapped up in the tech space right now is massive, and everyone's enjoying the silver lining, if you will. I hate to call it that, from the pandemic, is that as bad as things are in certain sectors, the tech sector's done really well. So everyone who has retirement savings wrapped up in anything that comes out of Silicon Valley or the startup universe that goes public, tech is doing really well. Well, that's great, but this is the second big issue for next year. The Europeans, so their economies are not in as good a shape as ours at the moment. Their banks are shaky because of the non-performing loans, and they're a bank-centric economy. They need revenue. And what is their biggest cash cow? A digital services tax. And obviously, the United States has not been supportive of the creation of a digital services tax in Europe for a lot of reasons, most of them good. Some people think, well, we have a new administration coming into the White House, and this is going to be a great thing for transatlantic harmony and international deals being struck. And here, history matters. Digital services tax was first proposed under the Obama-Biden administration. The Obama-Biden administration hated it then, and it didn't go anywhere. There's no reason to believe the Biden-Harris administration would support it at this stage. On top of that, on Capitol Hill, there's no bipartisan support for this concept. And so next year, we will see a lot of headlines because the international process through the OECD is likely going to not do well. And the Europeans are putting into place very incrementally, in very technical ways, individual initiatives designed to create the foundation for digital services tax. So next year, we're going to see, conflict, tension, headlines about the Silicon Valley giants and taxation in Europe, competition policy. The Trump administration sued on competition grounds. So that's not a policy that's going to change. There are a lot of very technical policy, digital privacy, data privacy. The dirty little secret about Washington is that there's actually a lot of bipartisan support, and we're going to see a lot of continuity for a lot of these policies. Those aren't going to change. Other things will change a lot, of course. In this space, not so much. And so if you've got your retirement savings wrapped up in Silicon Valley and you think these guys are never going to slow down, they're going to have challenges next year in a very big way. And I don't think the change in administration is going to make a difference. And if anything, it's going to be a wake-up call to a lot of people that just because we've got a change of administration, different wrapper, a kinder, softer, gentler, more diplomatic executive, doesn't mean we're going to agree with Europe anymore. Yeah. And the third, you asked me for the three big things, and the third one is, of course, digital currencies. I think we're going to see the European Union floating a digital euro. Not floating in the sense of trading in the markets, but I think by this time next year, we're going to have a concrete roadmap from them as exactly what it's going to look like. Okay. And that, so if you're an issuer of a digital currency, a private sector one, you're about to get competition. So everyone who's piling into cryptocurrencies, thinking this is, again, a juggernaut that can't stop, I think we're going to see some investment interests siphoning off. And it's not just that the central banks are going to be issuing digital currencies, but the regulatory communities, many of which are housed in the central banks, they're going to start tightening the regulatory noose because they want a level playing field. And so I think the investment space for digital currencies, private and public, is going to change dramatically over the course of the next 18 months. So if you're if you're an individual investor, you're advising individual investors, and this is where you're deciding to put some of the savings, I would think you would really want to know and be in a position to identify, do nowcasting for policy trajectories, if not on a day-to-day basis, certainly on a weekly basis, based on facts, because finding information about what's going on in this space is not so easy. It's not going to be in the New York Times every day or the Wall Street Journal.
Okay, so let me do my attempt at putting this together for clients. You know, I've talked to some, I've tried to talk some people out of the trees about their retirement savings over the last couple months here. So my takeaway is, number one is that 401k that looked impervious, right? And you had some doubts that this keep going. Yeah, that might be a real possibility. Your 401k balance will either not grow as fast or you may see it go down. Number two is, okay, great. Well, fleet of safety. Well, our business is built on the bond market. Ramsey, I didn't hear like the interest rates are going to go to zero, but I didn't hear that they're going to climb back to whatever normal was for the last couple of years. So,
I can talk about that too. That's 4 on my list, but I promised.
Oh, that
3.
is. Oh, see, door number 4. I got it. Well, we'll
door number 4.
And then the old flight to safety. Hey, but go buy gold, right? Maybe it's not go buy gold. Maybe it's go buy one of these currencies. Maybe that's the new safe haven based on what you're describing about it. Just now the question is which one of 100 different variants of this thing. So I don't know. To tell us your prognostication on.
I will tell you, but first I need to observe. So I think the best way to think about this is that every position an investor takes, large or small, has embedded implicit assumptions about the regulatory environment. They just do. And until recently, it's been really impossible to quantify what the risk is of a shift in policy trajectory. Our data makes it possible to make good decisions based on trajectory so that you can evaluate for whatever your time horizon is. Your time horizon is 3 months, 3 days, 3 years. What trajectory are you on? What are policymakers doing? Do you still love that position? Even if you love it, should you be getting rid of it? Are you ready to stand against the volatility is coming? So absolutely, this is where it goes. So on interest rates, policymakers are being very, very clear that, and they're putting into place really new policies designed to have entrenched low interest rates for much longer. Policymakers in Europe and Japan have been talking about negative interest rates in certain parts of the term structure. It's not always the headline. Sometimes it's the short term. An underappreciated element of the monetary policy decisions is a shift away from LIBOR, which is happening at the same time. So when the pricing benchmark changes, the target interest rate changes. It's no longer LIBOR, the London Interbank Offer Rate. It's going to be set at national level per currency. So that's going to complicate the monetary policy process a little bit more. And they're only just starting to talk about what that looks like. The concept that we're going to see interest rates above 1%, I don't even think it's on the planning horizon. I think the economies are so weak, and the structure of the economy is changing so fast that much of what economists and monetary policy theorists care about when it comes to identifying inflation rates and productivity rates. I mean, they're really, in many ways, tearing out the sheet of paper and starting anew. In that context, I don't know that there is a central bank out there that's even contemplating dramatic increases in interest rates at all, much less getting to anything like the targets that are traditional, whether it's 3% or whatever. But the key there is language, and we follow that very closely.
Okay. On that uplifting note.
Well,
if you're a fixed income investor, that's really not pretty, right? Because you're just not going to get the earnings. But what it also tells you is it tells you how to be an equity investor in a bank.
Well,
because
it also talks about, Mark, our product designs, our rate strat. I mean, there's
without a doubt. If I'm an individual going into retirement, and I've got my 401k and I'm looking to roll it over, to help generate income for the next 25, 30 years, I'm looking at the current environment, and it seems like, number one, volatility is here for the foreseeable future. Number two, things are going to become much more complex going forward. There's going to be a lot more, sources of data coming in to play, a lot more information points coming in. I think deciphering that is going to become just more and more challenging. So making a decision is going to become even more complicated. And you made a comment earlier, Barbara, which I really like, is that hope is not a strategy. And I think that the less certainty you have, the more you're relying on hope. And it sounds like there's going to be a lot more uncertainty out there. So if I'm an agent, I'm thinking, this is a great opportunity right now to really go out and talk to clients about ways I can put structure and certainty in place, and put guarantees in place. Take some of the same data analytics that insurance companies use in terms of predicting risk and mitigating risk, and putting safe strategies in place. But also, to the point that Ramsey brought up, I think, about the different crediting strategies that are available in the market that can really be structured to play into some of this volatility. So I think there's a huge opportunity from putting in some guaranteed products into a client's portfolio, sitting down and taking away some of that risk, some of that uncertainty, and again, not letting hope be the strategy, but putting a strategy in place that gives them hope going forward.
Exactly. And to build on that, so, we were just trashing fixed income because of the interest rate, but of course, people buy fixed income and sovereign fixed income specifically, not just because of the return. They buy for safety. And so understanding which government bonds effectively have a guaranteed buyer in the form of the central bank, and at which tenor, hugely important. Understanding when, because eventually we are going to see a taper, not anytime in the next 2 years, I think, but we are going to see a tapering of the Fed purchases, for example. When that happens, are we going to have another taper tantrum like we saw the last time? This system, making a concrete decision, making an informed, fact-based decision about when, whether, and how asset purchases will be tapered, delivers a different perspective on what's a safe investment. That isn't merely about the interest rate earned from the investment. There's a lot of other components, and I actually have great respect for the challenge that pension managers and annuity managers, investment managers that advise people on retirement, because the time horizon is so long. We've got to really play both the short and the long to understand the time horizon, to understand what's going to be safe for an individual investor. So I would recommend you don't look at the fact that there are low interest rates for a long time and say, forget that bond market. No, I think you've got to look at it from the perspective of what policies are supporting that bond market, and look at it from that perspective, and then identify for the investor, how safe do they want to be, and when do they need to be out, and if they've invested in, a bond from country X, and in 6 months, country X is going to have a massive non-performing loan problem in its banking sector. Are they willing to ride out the volatility or not? These are very difficult questions. But I think we give them better information, you make a better decision. And that's got to be a good thing for everybody.
Okay, this has been fascinating. Unfortunately, we're like right up at our time. Mark, any final thoughts?
Yeah, I guess one question from a practical standpoint. So if I'm sitting watching the evening news, right, and I'm just trying to gather the data, are there any like quick tells that you have that you can determine what's fact, what's rhetoric? Like, is there anything that you can offer that might say, hey, if you hear these things, maybe take a second look at it?
I don't think it's so much a term as it is the source. So with all due respect to my friends who are pundits, and I have a lot of them, a pundit's opinion is an opinion. I would hold fast and hard to what someone with authority to act, what they're saying, concretely, without a filter, without interpretation. I think what the facts matter more than anything. So, if you're watching the evening news and they're interviewing august person X over here, who's had multiple important positions, and maybe you're kind of hoping they have some inside information, but they're not going to share it, but you care about their opinion, I would suggest to you it's just an opinion.
Opinions, yeah, facts, not opinions. Ramsey.
So lots of different things there. So, on that last point, what the news business has become one of, there's got to be sort of a thrill. It has to be interesting. It's entertainment. The focus is more on entertainment than information transmission. So you can see how there can be sort of missed signals there that you can take advantage of. On interest rates, I think interest rates are low and are going to stay low for quite some time. And I think cryptocurrency, I think people will be drawn to cryptocurrency both by this sort of massive consensus that continues to burgeon and to increase, but also the fact that that's kind of maybe where the returns are. Like we may, if we can't look to certain other places for returns, it's going to draw people more into cryptocurrency. And I think on the issue of what's going to replace gold, it's hard to see any other coin except for Bitcoin doing that. As for other applications of cryptocurrency, you're right. Like there's a lot more sort of a potential, what's the word I'm looking for? Potential competitors for the throne there.
Yeah, and they're not going to have a free ride on the regulatory front going forward. And so understanding that there will be costs associated with increased regulatory burden is crucial to making a good investment in that space.
I think regs are good for cryptocurrency. I think it will allow, right? It will allow lots of big institutions to feel comfortable coming in. So I'm bullish on reg in that area.
Yeah, you just need to understand that it's coming.
Yeah.
Right. Right. Well, Barbara, listen, thanks so much for your time. And if people want to find out more about your company, your product, or where should they go?
Well, they should go to our product website, policyscope.io.
Policyscope.io. We'll put the link in our in the show notes. And Barbara, thanks so much for the time. I mean, this is a fascinating discussion.
Oh, I enjoyed the discussion and the questions. They were good ones. I really enjoyed the conversation. I really appreciate your having me on the show.
Yeah. Hey, thanks so much. And for our listeners, thanks for joining us today. And please tell your friends if you like this. If you don't, that's okay. And join us again next week for another episode of That Annuity Show.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.